Hi everyone, let's talk accounting changes and error corrections. We're getting near the end of the book here. Alright, so the types of accounting changes. We're going to talk about what is a change in principle, a change in estimate, a change in reporting entity, and on the next slide there's going to be one more, which is going to be errors. How do we deal with them? So we categorize these things, the changes that we're making, based on what kind of precipitated the change, and then that's going to determine how we treat the change. Okay, so a change, for example, a change in accounting principle, what does that mean? It means you change from one GAAP method to another. Which one of the easiest ones to think about is, what if you changed the way you handled inventory? You went from FIFO to weighted average. That's a change in principle. Totally okay, completely normal to do. So it's going to have its own treatment. I'm not going to get into the treatments just yet. And there's some more examples here as well. Change in accounting estimate. What if you revise an estimate that you had before based on new information you have? So that could be something like you change how you depreciate an asset, or you decided that you weren't calculating enough for accounts receivable not being unpaid, going uncollectible. So it's just a change in estimate, and we're going to have treatment for that. Change in reporting entity. What if you were one company and now you've bought another company, or maybe your two companies have merged? How do you deal with the treatment of that? Okay, and the last one, correction of errors. What if somebody made a mistake? People are the ones preparing these tax returns. People are the ones preparing these, financial statements and whatnot. So mistakes are made, and sometimes they're bigger than others. All right, so let's take a look at the different approaches. First one is the retrospective approach. And the idea with the retrospective approach, if you remember, financial statements have at least 2 years worth of data, more often than not 3 years worth of data. So the idea is, with a retrospective approach, you change everything that happened as if it happened all the way from the beginning. So like we were talking about inventory changes. If you were to change your inventory methodology, you went from weighted average to FIFO. The idea is that you would then have to restate all of your previous financial statements, the 3 years or so, 4 years, 5 years, probably at least 3 years, 3 years that you presented, as if you had been using the new method all the way along. And you would even look back in time and you would have some sort of cumulative effect, meaning, what if I had gone, to FIFO, weighted average to FIFO? What if instead of weighted average, you'd been using FIFO all the way since the inception of your company? Then you'd have to report that cumulative effect. Okay, that's retrospective. You look back, you present the financial statement as if you'd been using the new approach the whole time, and you fix everything before that. Modified retrospective approach is kind of somewhere in the middle of this. Well, it's just a slight change on the retrospective. The idea being you're only changing the current period and you're adjusting retained earnings. So you're not, like I was saying before, you're not going back the 20 years or so you've been in business and modifying your records, right, so that your numbers are all appropriate carrying forward, things like your retained earnings and whatnot. Instead, you only go back so far. You fix the current period to being the new methodology, and maybe you just adjust the retained earnings balance at the beginning of the year, but you don't go back and figure out the cumulative effect for the last 20 years. Okay. Prospective approach means from the day you decide to make the change forward, you're going to make the changes. And you see that more often than not with the change in estimates. So if you change the way you decided to depreciate something, you're going to not go back and fix previous year's depreciation. You're going to make the change then and carry it forward. Okay, those are your approaches. All right, so change in accounting principle is a change from one generally accepted accounting principle to another. The idea being you want consistency, you want comparable financial statements. So you want it to be the same from year to year. You can't really compare very well a company that has a lot of inventory and is using, LIFO versus FIFO. They need to be comparable. So you want to make sure that you are changing for a good reason, because it's a big change, and you want to make sure that the change in accounting principle is represented in each year. Okay, and there's a couple of examples they give you there. Oh, come on. All right. Motivation for accounting changes. Now you want, of course, you can read through this, but the idea is basically make sure that the changes are being made for a practical reason. Meaning, maybe just LIFO, in all fairness, LIFO's kind of dumb. What if you just don't want to use that anymore, right? You want to go with something more commonplace, something that makes a little bit more sense. That would be a reason that you'd want to change maybe your financial statements, or rather you would change your principal. What this is trying to tell you is make sure that you've got a good motivation for making these accounting changes. You're not just messing around with the earnings, right? So you've heard about that earnings, what is it? Earnings management? I forget how your book calls it. Earnings management, earnings manipulation. You don't want them making accounting changes to basically make the records look the way they want them to, right? You don't want any manipulation. Now, management tends to want to see nice, smooth growth, nice, smooth, steady growth, right? Because that's reliable and predictable and shows well for a company. The last thing they want to do is see this in their financial statements, right? Like huge income, low income, huge income, low income. You want nice, steady, solid growth. That's what investors want to see. So managers may tend to, manipulate earnings a little bit so that it winds up looking smooth, not a little crazy. All right, so point being is you're the accountant, use some professional skepticism and say that doesn't make sense for us to do that. We're not looking to manipulate earnings. All right, so let's get into an example of changing accounting principles reported retrospectively, right? Changing his accounting principles, again, retrospective. You go back and you fix all the previous years, and you go back and fix even the 20 years you did before, and you report like a cumulative change amount. The idea being it's as if you've been using the other way, the other principle, whatever you're switching to, the whole way. Okay, so here we go. We're switching from LIFO to FIFO. All right, if you want to pause this and read through it. But the idea is that these are the previous year's cost of goods sold under LIFO versus FIFO. Now remember, LIFO is last in, first out, meaning if it's a period of rising prices, the most expensive inventory is getting sold first, the newest stuff, which makes your expenses high, right? Your cost of goods sold really high because you're in theory selling the most expensive inventory you have, and unfortunately, your balance sheet tends to be understated because it looks like you have all the old inventory on there. But the benefit of LIFO is with the high expenses, the high cost of goods sold, it means a lower net income. Now imagine we're going to switch here from LIFO to FIFO. So what's going to happen? We're going to have overstated income. It's going to need to be brought back down. It's a whole thing. So let's get into it. All right, we're going to look in the previous years, and like if we had in the previous years used LIFO, or rather our previous year's numbers using LIFO was 2,000, our cost of goods sold. If we had been using FIFO the whole time, our previous years, right, this is the cumulative years, would have had $1,700 in FIFO, so $300 difference. They give you the revenues and operating expenses and dividends and so on, income tax rates. But here's our 3 years that we're presenting. We'll focus on 2019. If we had our 2019 record showed our financial statements at that time would have shown LIFO, cost of goods sold, of $400. But had we been using FIFO, it would have been $360. So you get a $40 change there. Now again, this is millions, right? But dollars, we'll say. You'd have a $40 change there. Here you'd have a $44 change. Here you'd have a $48 change. Okay, so kind of carry that information through. And this is in your book too, so you can follow along there if you want to. All right, so we would have to revise the financial statements. That's the whole point, right? We're retrospective. We have to make them comparable and show it as if we've been using FIFO the whole way along. All right, so what we'd have is we would then present it with the new FIFO numbers, 360, 365, 370 as our cost of goods sold. So I'm going to go back over just a second. See, 360, 365, 370. We're going to pretend as if we've been using FIFO the whole way. All right, so what happens there, it changes then our net income numbers. It would, because before I had 340 there, right? 340? No, 400, sorry. Bad number. I had 400 there in 2019. If I had 400 there before, that means my net income would be lower because my expenses would be higher. So now what is it? Now what happens, right? Okay, let's take it to the next step. What happens? Well, the differences between the years, right? There's a $40 difference there. In 2020, it would have been a $44 difference, 2021, $48. And this is the difference. This is back from the first slide. So we would be looking at the cumulative differences. If you think about it, if inventory is one of two places, it's either on your balance sheet, unsold, right, in your inventory, or it's been sold. And that means it's cost of goods sold on your income statement. So if in the past I had said inventory is worth 400, if I'm looking at, again, at 2019 here, if inventory cost of goods sold had been 400, okay, 400, but now I'm saying it's really 360. That means I'm lowering the cost of goods sold, which means my balance sheet assets inventory will go up, okay, because the idea is that it's either, if you record that you sold less dollar amount wise, then you're going to say that you have a higher dollar amount still sitting in your ending inventory. Okay, so it's a little bit of a mind bend there. All right, so what's going to happen? Our cost of goods sold, this is, again, previous years is the cumulative effect of however many years were prior to this. But the idea is that you're going to have 300 here, plus you've got a $40 change here. Plus, after 2 years, the cumulative effect of the change is an additional $44, we're at $384. And then the cumulative effect of this change after 3 years is $432, right? Because the idea is it's a cumulative change over all those years. And your income taxes are going to change too, because in theory you're paying taxes on a different amount. You'd probably have to go back and restate some of those tax returns. Not really totally sure about that. Corporate's not my forte. All right. Oh, and there we go. Okay, so I'll let you read through that. It's basically what I just said. All right. So the retained earnings from 2019 is going to be reflective of everything that would have happened before then. We would be grabbing, I don't think it's in there now. We'd be grabbing a new retained earnings number here. But revise the information of FIFO, right? We'd have the shareholders' equity statement, and we would have the new number, the new net income of 231, which is 255 out after probably, no? Yeah, I don't know where. 231, somewhere that 231 is coming into play. 231 less the 40 is 1116 minus the new net income, 243.40, right? So the idea is you'd be restating the statement of stockholders' equity or shareholders' equity with the new net income numbers. Okay, I had to go back to see where those were coming from. There you go. There's your 231, there's your 243, there's your 270. So the results of the net income. All right, so back to where we just were. 231, 243. Okay. The other thing you need to do, you need to adjust your inventory count, right? Because like I was saying, now that we're saying we have a higher amount of inventory, since we have now just decreased our cost of goods sold number, that means we have to record the higher inventory number. So we're going to bring the inventory number up by that cumulative difference that we looked at before by 384. We'll adjust our retained earnings, because the idea is your retained earnings would go up because, ready? You have to follow through here. If your cost of goods sold went down by going to FIFO, that means you have less expenses, which means you have more net income, right? We saw that, which means you would have more retained earnings. Okay, and the income tax payable piece. All right, disclosure notes. Pretty much any of these changes we're going to be going through, I'm at 13 minutes already, any of these changes that we're going through are going to require disclosure notes. You have to say why you made these changes, because somebody's going to be looking and going, that's not what you presented last year. I'm standing here holding the financial statements from last year, and why do they not match? What's going on here? There should be a footnote explaining why, explaining the difference, and so on. Okay? All right. I'm going to pause you guys and move on to the modified retrospective when we come back in part 2.